we think about the matching principle, this is an accounting principle that governs how we record certain activities in business. We typically talk about the matching principle when we're thinking about when to recognize revenue or when to recognize an expense. So the two things here, we want to match expenses with the revenue that those expenses generate, or we want to recognize an expense across the periods that that expense is benefiting. For example, if we book or buy inventory in December, these are items that we're going to sell, and we actually sell them in January, well, we'd want to not expense them in December when we buy them. We'd want to expense them in January when we actually sold the items, because it's matching, the expense is matching the revenue that those items are generating. Another example is if we had like a 6-month insurance premium. Well, if it's benefiting 6 months of time, we're going to actually divide that expense over the 6 periods that it's benefiting. Okay, so hopefully it gives you some context when your accounting colleagues are explaining when they decide when to recognize revenue or when they're recognizing expense. This matching principle is governing some of their thinking.